So overall, net, sales at retail are decelerating. Margins are going to look really good. EPS is probably fine. Relative to the trend over the past 1, 2, 3 years, if these guys are actually hitting numbers, it's bullish.
Yeah.
There's no doubt about it. I mean, it is bullish. All right, so 2 or 3 tail factors here. So tail bearish. All right, so I hit on this trend once, and I'll hit on it again, and then I'll hit on it again. That's how important it is.
Yeah.
And it's how underappreciated it is. So if you look at how we consume things, and I kind of laugh if I'm in a meeting, no offense to anyone who's on this call who I'm in meetings with, some of the people I'm talking to were in high school or 8th grade when the stuff started playing out. No offense, Ben.
That's fine.
I think you're a millennial, right?
Yeah.
Yeah, all right. You're an older millennial.
Yeah.
You're not. All right. You're still a millennial.
I think I'm 4 years. Make the cutoff by 4 years.
Welcome to Hedgeye.
It was 84, right, is the low end?
Yeah, let's get Neil Howe in here, but I think. So overall, this here looks at apparel. And this, I think, addresses the whole border tax. It's on, off every day, right? So back in 1990, we consumed 30 units of apparel a year. Every person, on average, bought 30 things that you and I are wearing. Most of it was actually made in this country, North Carolina. That's why you had Warren Buffett buying all these manufacturing assets at 3.5 times EBITDA.
Yeah.
Huge. As we saw the shift over to China, which happened because of change in the trade regulations as far as how many units we could import from World Trade Organizations or not, I won't hit on that. The fact is, you gotta trust me on this, from 1994 through 2004, there was a colossal 10-year one-time, it was a paradigm shift. No doubt about it.
Yeah.
So while that happened, you had the consumption that actually went up. We consume 84 units of apparel a year. You're probably saying, no, Brian, that's not right. It's right.
Yeah.
It is right. So
wow.
What happened is we pumped more velocity through the retail channel. What did that do? I mean, these guys, yeah, they make money plus or minus based on if they discount at 5% or discount at 2% or have prices up 3%. But as they pump more volume through the pipe, that's when they print money. That's when, oh, these things are cheap on cash flow. Yeah, they're cheap on cash flow while they're pumping through units.
Fixed cost leverage, that kind of.
Right, until they're not. So on this next slide, this is like my Trump hates Kohl slide. So that time period, 1994 through 2004, right? This is when you had that big shift.
Wow.
What happened here?
10% to 40%.
Yeah. So what happened here? Kohl's was a cult stock. It was it's an offset to the dying regional mall. Well, guess what? The regional mall's not dying anymore. When I started in this business in 1993, you had 1,100 regional malls. Guess how many you have now?
4,000.
1,100 regional malls. You still have the same number. It's kind of like oceanfront real estate, right? You can't make more oceanfront real estate. If you are Kohl's, right? You operate in strip malls. When I was 23 years old, they had, 1,000 strip malls. We had 1,000 strip malls in this country. Kohl's has this great strategy. They could grow in a box 20 minutes, 10 minutes from where you live instead of you going to a mall. That's a half an hour drive. So you had that happen. How many strip malls are there now? 7,000, right? If you want to go out there and you want to build it, if you're Dick's Sporting Goods, you want to build another store.
What? It was, how much was it when you were?
1,000.
Oh, 1,000 to 7,000.
Yeah. Because if you want to go out and build another strip mall, you find a landlord and they build it.
Yeah.
It's as simple as that. I mean, there's this whole push out there right now. Amazon will build stores, will buy stores, and they will. No. So Amazon will have stores.
Yeah.
Everyone thinks, okay, they're going to buy it. If you're Amazon and you're going out there and you need to have this great store that all of us, me included, can't even conceive at this point. Imagine this 100,000 square foot box. You walk in, looks great. You can buy some stuff there, but you look up and there's like a pick and pack operation with 3 people over 60,000 square feet up top, 50. And you got these robots and 3 employees. It's so efficient. They like pick things. That's commercial. That's cool. That's like you go into a car wash over the past 20 years. You bring your kid and they see the car go through. It's so commercial. That's what Nike's doing now with manufacturing.
Yeah.
They will. This is a huge, huge event. They're going to have it in their actual stores. So cool.
Wow.
So
I didn't know that.
And most people don't. That's why Nike's a $55 stock instead of a $150 stock.
Yeah.
So when you look at all this and how it's playing out, if you're Amazon, are you going to buy a Kohl's store? People think they will. you're going to go to a landlord and say, hey, let's build a new center. And not only am I not going to pay you rent, you're going to pay me rent. You are going to pay me to occupy a 100,000 square foot box. I've seen that once before. It's when you have like the Stanford Town Center, which is one of the worst malls ever, and you have an Apple store. Why do you have an Apple store? Because Stanford Town Center paid them to occupy that space, and then they jack up rent in the Abercrombie store, which you walk by and it smells like garbage. Well, if you're a landlord, you pay Apple to occupy the space.
Why would they do that though?
They would do it so you got a box next door to it, and they could jack up rent. Say you're paying $25 a foot, now you're paying us $50 because you want higher traffic, so you're next to an Apple store. Yeah. Same exact thing here. If you're Amazon, you're going to build a box. They're going to pay you to sit there. They're going to attract an Arc'teryx, a Montclair, a Prada, or even like I don't know, Free People.
It doesn't have to be that high.
It really doesn't matter. They're going to pay because they need traffic more than ever. Really, really key trend. So I don't even know how I got there. The fact is,
no, that's interesting.
There's a lot of companies which are billed as, hey, it's a takeout. Guess what? Not takeout. Not going to happen. If I'm Macy's and I'm, I'll be bought. Trust me, you won't be bought. I can't say trust. I don't think it will be bought. What Macy's should be doing now, it should be buying. It should be buying content. Why doesn't it buy Kate Spade? Why doesn't it buy some brand where it can put it in that box and say you can only get it here? Amazon bid on American Apparel. And they apparently didn't want it that bad because Amazon lost it to Gildan. Like a $90 million deal. Again, if Amazon wanted it, they would have done it. But if you're in there to bid, if you're Amazon on the rights to stream NBA games live and you're going up against ESPN and Ted Turner, good luck with that, right? I mean, good luck trying to compete with Amazon. So this is what these companies strategically should be doing. And they're simply not doing it. Yeah. Everyone in the market, hey, they'll be taken out. Look at content. Content will be taken out, not old crappy distribution.
Right.
So anyway, I have another slide or two here. Let's just can it. I love the Trump hates Target slide. I mean, there's so many companies where they just they are just in super big trouble.
Yeah.
So I'll stop there.